All right, so let's talk about debt-to-income ratio. What is it? What goes into it? How's it calculated? All the nuts and bolts of debt-to-income ratio. So I'm Jayson Bates, owner of Electrum Financial. Don't forget to subscribe to my channel here. I really would appreciate that. So thank you. Share with your friends and family if they're looking to buy or refinance a property. I certainly would love to help them. Okay, so I thought today we talk about debt-to-income ratio, what goes into it, how's it calculated, what are some of the things that an underwriter looks at when calculating debt-to-income ratio. And so I thought the best way to do that and illustrate that would be to take you into my origination system so I can show you firsthand rather than getting some kind of whiteboard and stuff like that. Let's dive you right into my origination system. So let's do that here real quick. And so with that, let's kind of dive into debt-to-income ratio and kind of zoom in here. On this, I just set this file up as an example here. Obviously, yours may change or may vary slightly from what your debts are. But if we look at, there's two things, and I want to kind of highlight here for us real quick. There's two things on the debt-to-income ratio. If you look at the first number, it's 33.57. That's the front-end debt ratio. And then you have the back-end debt ratio, the 45%. And so what are those two things? What are the differences between those two things? Well, the front-end debt ratio is your housing ratio. That's a relationship between your house payment and your income that you have coming in. How much of a percentage, as a percentage, how much does that house payment represent of your income? And then the back-end debt ratio, which is what most people kind of refer to when you're talking debt-to-income ratio, that is the new house payment plus your other debts. And so what is the total relationship of your debts in relation to your income? Now, when we talk about debts, what are we talking about? We're talking about anything that shows up on your credit report, pretty much. We're not talking about cell phone bills. We're not talking about water bills. We're not talking about utility bills. We're not talking about any of those things. Okay, those are all separate. School tuition, doesn't matter. Anything on your credit report. So credit cards, student loans, installment loans, furniture loans, automobiles, anything like that shows up on your credit report, that's what's affecting the debt-to-income ratio when qualifying for a home. So, and I've got some examples of that here. The one thing I want to make clear here is the housing ratio, because I think that gets overlooked quite a bit here. And when I first started, the housing ratio max was 28%. Now I'm seeing housing ratios upwards of 45, 43, 47% debt-to-income ratio. And remember, this is of the gross income, not your take home. You may say to yourself, well, I make $5,000 a month, but I only take home, $2,700 or $3,500 a month after your 401k and everything else that you may pay on those sort of things. Well, qualifying for a house, they take your gross monthly income, the gross, and divide that into your monthly debts that show up on your credit report. Those are the ratios, and those are how those are calculated. So let's dive into that and see how that affects things here for you. So let's jump back into this here. And sorry, I didn't mean to zoom in too much there. So I've got some debts here and let me just kind of back up here for a little bit and kind of zoom in here a little bit and show you kind of how this is kind of set up here for us. So if I scroll down here just a little bit, I have it on a $310,000 sales price, or excuse me, $290,000 sales price. Let me change that here a little bit. I know I put that at 310, but we're going to put that at 310. And that's 3.5% down as a down payment. And we're looking at FHA at 2.5% as an interest rate. Okay, so that's kind of how that is all set up. And so when we plug those numbers in, then that's going to give us, my internet kicks in here, it's going to give us a payment here of $1,242.62, principal and interest only. Then I added insurance at $60 a month, property taxes at $224, mortgage insurance, which is required by FHA, $209, and then HOA, which here in Phoenix we have a lot of HOAs. So average about $50 a month for HOA to give you a total payment of $1,786. So that is the number that is used now for that front end ratio. So you notice here 1786, that's 35%. That represents 35% of $5,000 of the monthly income. Okay, so that's how that's calculated, the housing ratio. Now, if we go back here and we go into the liabilities, which I know you're not able to see, which I will get to here right now. So liabilities. So these liabilities here, again, just a snapshot real quick of what I see on an average basis. So automobile payment, $30,000 balance, $500 a month. Credit card, $8,000 in credit cards. That might represent 2 or 3, maybe 4 credit cards, $150 a month. And then student loans. This is the big one. This is a big one that really is something that I can't stress enough. Student loans are kind of a ball and chain when you're looking to buy a home, because you may not be paying anything on your student loans. I get it. You're in deferment. Maybe you're still in school, going for your doctorate, going for your master's, whatever the case may be. You're not making payments on that student loan. Maybe they're even income based. You get out of school, you're not making as much money as you thought you were going to make. You have a lot of student loan debt. They adjust the payment to match your income. Well, when it comes to a mortgage, it doesn't necessarily work that way. If you're not making a payment, they're going to take either the fully amortized payment, so you got to prove the payment, whatever that may be, or they're going to take 1% of the payment and calculate that in your debt to income ratio. Now, again, you may not be making any payment whatsoever to that student loan, but for qualification purposes, we're going to hit you with that payment. So if we jump back into this here real quick, we notice that the back-end debt ratio with those debts is at 48%. So that's not paying any student loan. So now if we go down here and we add in a student loan payment of 1%, okay, so $35,000 in student loan, but we got to add 1% to a payment to qualify you, right? So it's $350. So now that $350 now brings your debt ratio now up to a 55.74, which that's no bueno. That's not going to work. Over 55%, even on FHA, is not going to work. Now, you got a couple options. You either lower the interest rate, but remember, we're already at 275, so you can't get a better interest rate. You can get rid of the HOA, find a house without an HOA. Okay, that might do it. Maybe the taxes, maybe the house you find has lower taxes. That might do it and get you under 55%. The only other option then is to reduce the sales price. So now if we go back in here, I'm sorry to have you jumping all around here, but if we go back in here and we adjust the sales price down to, let's say, $290,000, still putting the 3.5% down. Now, where does that put our debt ratio? Look at it, it's at 53.57. So now we're under 55%, right? We're under 55%, but we're also reducing our purchasing power by $20,000 just from that student loan. So student loans can weigh heavily on the debt to income ratio and getting you qualified. That $20,000 might mean location, might mean not having a pool, might mean having a carport instead of a 2-car garage. Could mean a myriad of things and take you out of a price point. You're dropping from $300,000 down below $300,000, which is a whole nother tier level. So I hope that better illustrates or gives you some clarity on debt to income ratio and how that can affect and what I'm looking at, what underwriters are looking at to help get you qualified. So remember, take all the debts that are on your credit report, use those as the basis to calculate your debt to income ratio, and use your gross income, not your net income, but your gross income to calculate the debt to income ratio as well. So with that, I'll go ahead and end this. I know it was kind of long. I apologize that this is a super important subject, because remember, stability, ability, and intent. We talked about ability today with debt to income ratio. So hopefully that gives you some clarification on how to calculate that. I'd love to be your loan officer of choice. So if you're looking to purchase or refinance, please reach out to me, subscribe to the channel, share with your friends and family, and happy house hunting.